Hello and welcome to the latest Wealth of Advice market update recorded on the 5th of December 2023. Recorded on the 5th of December 2023. Recording this after a very positive month of November. Markets responded very well from the negative. October, September and August were pretty flat as well, but October was really worrying. The conflict in the Middle East had just kicked off. Markets fell. Thankfully, it wasn't a precursor to bigger things over in that region, and the inflation data that came through in November was really positive both in the US and the UK, and markets lifted on the back of that. The next big thing that we're going to look for is what happens with inflation when the numbers come out this month. I think the 14th of December is when the Federal Reserve are having their next meeting. That will be a big day for markets to see what their views are, and then hopefully we will see interest rates start to come down in 2024. I think there's lots of things to be positive about in 2024. We've got elections going on in different places in the world. Hopefully the inflation figures continue to go down, interest rates go down, the world avoids a huge recession. So 2024 could be good. I feel a lot more positive now than I certainly did back in October. So my colleague Matthew is going to record the bulk of this market update. I feel a little bit bunged up. It's that time of year again when everyone's got all the sniffles, and I don't want to sound like him off the Vicks Vapor Rub advert for you all. So Matthew's going to record most of it. However, I do want to just remind people that we've sent out the invites for the Wealth of Advice annual client conference seminar that we're holding at Durham Cricket Ground again at the end of January. It'll be the final Friday of the month, the 26th of January. We've sent invites out to people last week. I think there's around about 50 to 60 responses have come in already, which is absolutely fantastic. The room that we have there holds just over 100 people, so I'm not saying seats are selling out fast. However, please get those responses in for anyone who wants to come. We've got a good mix of fund managers coming to talk about a few different things. HSBC, multi-asset fund managers coming, but we've never heard him speak before. Elston, who do a lot of our investment fund research with us, help us build our model portfolios. They're sending a couple of guys up. T. Rowe Price, again, is sending someone, and Roy London are sending a fund manager over just to give their views on what 2024 may look like, discuss obviously what's gone on in 2023. It was a great event when we held it there last year. Food will be provided when people arrive. Food was really good, and then at the end, after all the presentations, they do open the bar, so there's a fair few clients who used to work together at different places. Good opportunity for a bit of a chin wag and a catch up with people you might not see for a while, or take the opportunity to have a big crack with me, Matthew, and the other members of the team from Wealth of Advice who will be there. Any questions will be answered. So love to see as many of you there as possible. As ever, anyone who can't attend, we will record videos from the day and put that on our YouTube page and send that across to people. So it's not the end of the world for anyone who can't attend, but anyone who can, I look forward to seeing you in the new year.
As we approach the end of the year, it's been a positive month for equities. Global equity markets have rebounded sharply in November, with the US equities up almost 10%. This is only the 8th time since 1928 that the S&P 500 has risen over 8% in the month of November. For our clients, this has certainly rewarded long-term investors, as it's the equity markets that have picked up and added that performance to your investments in this month. When we go through this market update, we're going to look at the reasons for that positive performance, and we're also going to talk about a conference that Jordan and I attended down in Harrogate, where we heard from 20 fund managers with their outlook for the future. So, as well as that strong equity performance, we've also seen positive inflation figures, which has given investors a new level of optimism, which is certainly positive as we approach the end of the year. When we speak to Elston and reflect on their commentary, it's interesting to see how the AI revolution has also affected investments. Microsoft shares have reached an all-time high in November, and it comes close to overtaking Apple as the world's largest stock by market capitalization. This is showing resilient earnings and strong growth from those AI revolutions that we've talked about previously, and equity analysts have started to upgrade earnings forecast for 2024 for companies such as Microsoft, which is a positive when we think about US equity exposure and the long-term investor. When we look at bonds, global bonds also had one of its best months performances since 1985, rising by 5%. This was driven by indications from the US Fed that they are now done with interest rate hikes. Inflation and interest rates has definitely dominated all our market updates this year, and certainly dominated lots of our conversations with clients when people have been talking about cash rates, when people have been talking about mortgages for family members that are coming off fixed rate deals. It's always that inflation story and that interest rate journey which is dictating those sorts of conversations. When Jordan and I attended the RSMR Seminar down in Harrogate recently, we heard from a lot of fund managers. They all had different specialisms and slightly different views on the world, but it was certainly positive to hear that global inflation is forecast to be down at around 3% next year. The Bank of England, the US Treasury and the European central banks are all expected to start cutting rates next year, potentially mid next year, and we'll see that flow through onto the likes of mortgages and also cash accounts and the likes. So don't be surprised if the Bank of England are the first to cut interest rates next year, as the economic outlook for the UK is poor and they don't want to create any cracks or break anything by holding interest rates high for too long. When interest rates do go up quickly like we've seen, historically they come down quickly too. So if you do lock in with a fixed term cash product, you might find it hard when you come to reinvest in the future or even to redeploy in the markets. This rhetoric of interest rates coming down quickly has been seen with banks and building societies starting to pull their larger cash deals. NS&I recently pulled their 6.2% one-year fixed bond after high demand, and they replaced this with a 3-year bond which was offering 3.95%, certainly not as attractive as the 6% offered. This chart from Bloomberg shows market expectations of when the US Feds are expected to cut interest rates. As you can see, it's expected from June, July to then come down, and potentially by December, interest rates could have been cut by 75 basis points. I touched upon AI earlier, and that was certainly an area of conversation when we were down in the recent seminar. The first half of 2023 was all about the AI hype, how AI transformations could hugely impact businesses. It took 7 years to get 100 million users of the internet, but it's only taken 2 months to get 100 million users of AI. Nvidia are forecast to make more revenue in their data center business next year compared to the last decade. Alphabet, Google's parent company, have employed the greatest number of AI engineers in the last decade, but haven't shown their hand yet, so it'll be interesting to see what their products reveal in the future. The big benefit of this is productivity, and that helps solve inflation. In the last quarter of the US, productivity has risen by 4%, and that's the highest number for many years. We also had an update from a fund manager on their view of Europe. European companies look attractive as they have some discounts compared to US companies of potentially up to 35%. Shell is an example which trades at a large discount compared to ExxonMobil, but they have the same style asset. There are big discrepancies on company valuations on whether they're listed in the US or not. Therefore, fund managers might look to exploit this by getting the same sort of exposure to an asset class, but at a cheap price. One fund manager also pointed out that the EU's £600 billion recovery fund has yet to be deployed, and over the next 3 years, this could certainly create a strong tailwind for growth. Interest rates and inflation have certainly been the key talking point this year, and it would be amiss for us to not look at those figures again today. As you can see from this chart, inflation is coming down across the major industrial economies. The Bank of England and the US Federal Reserve have both held interest rates steady as inflation continues to fall. The UK CPI fell to 4.6% and the US CPI fell to 3.2%. The Bank of England said inflation is expected to continue to fall sharply, and we will be watching closely to see if further increases are needed, but even if they are not needed, it is much too early to be thinking about rate cuts. A lot of fund managers' views on this is that they are trying to manage expectations so that people don't get carried away with a cut earlier than expected. But when we talk to fund managers, they had a view that it could be Bank of England that makes the first cut, as they want to be ahead of the curve and certainly don't want to see the UK economy cracking. Especially next year with political change and elections coming up, they want to be on the front foot to be making strong changes rather than be left with a damaged economy going forward. In global news, US President Biden met with Chinese President Xi last week, Biden stressed the importance of peace and stability in Taiwan. Xi said China had no plans for military action against Taiwan in the coming years, but also discussed conditions when military force may be required. I think the positive news from the global side of things here is that the two leaders agreed to resume talks that had previously broken down in August 2022. When we look at the usual market performance, as you can see over the last 3 months for stock markets, it's been a positive finish to the period, with all three major indices finishing positive. When we look at the same stock market indices year to date, you can see the reward for staying invested. The FTSE 100, as we've talked about previously, has lagged behind, but it may be that there's opportunities going forward where valuations both in Europe and the UK look promising compared to the US, and that's something that our fund managers will always be looking at to see if there's opportunity to add value for yourselves. Thank you for watching another market update video. If you've got any questions, please feel free to get in touch. As Christmas is approaching, just to let you know that the office will be closed from Friday the 22nd, and it reopens on Wednesday the 3rd of January. If I don't speak to you in the meantime, have a great Christmas.